So good afternoon, everyone. My name is Eloi Colldeforns. I'm an LL.M student here at Harvard Law School, and I'm also the international chair of HLSBFI, the Harvard Law School Blockchain and FinTech Initiative. On behalf of HLSBFI, I welcome you to our first annual conference, which bears the title Blockchain, Fintech and the Law. And will feature a number of talks with leading legal practitioners, industry experts, academics, and regulators over the course of today and tomorrow. You can check our event website. We're going to write it on the blackboard in a few minutes for more information on our next events. So this first panel discussion that I have the pleasure to introduce will refer to the fintech ecosystem, regulatory challenges, and international expansion. Let me introduce the fabulous speakers that are here with us. So on your right is Mr. Benjamin Bay, the Vice President and Chief IP Counsel of Ant Financial, the parent company of Alipay, which operates the world's largest online and mobile payments platform. Mr. Bay is responsible for all aspects of protecting and enforcing the company's intellectual property. And before joining Ant Financial, Mr. Bay was a partner at the international law firms Jones Day and Allen & Overy in the United States and China, and focused on high-stake IP litigation and licensing. Numerous awards distinguish him as one of the world's leading patent lawyers. So next, second on the right is Mr. Daniel Friedberg. He is the chair of the payment systems practice at the law firm Fenwick and West. He has more than 20 years of experience representing an expansive range of businesses in financial regulatory matters, including banking and non-banking companies. Mr. Friedberg's fintech practice includes representation of companies that are money transmitters, digital currency issuers, and mobile payment providers. Mr. Friedberg also assisted many startup banks in obtaining federal and state charters and has advised such banks on operational and governance matters. Next is Mr. Joel Telpner, who chairs the FinTech and Blockchain practice group of the law firm Sullivan Worcester. He has structured some of the first token sales and blockchain-based applications, including the first issuance of digital securities utilizing blockchain technology. Mr. Telpner brings more than 30 years of legal experience in a career that includes time as an AM Law 100 partner, the former U.S. General Counsel of a global financial institution, and a venture capitalist. He was named as one of the top 10 fintech attorneys in America by Chambers and Partners in their FinTech 2019 edition. So this panel will be moderated by Professor Howell Jackson on the top left, who probably requires no introduction to many of you. He is the James S. Reed Jr. Professor of Law at Harvard Law School, and his research interests include financial regulation, consumer protection, international finance, and federal budget policy. Professor Jackson has served as a consultant to the United States Treasury Department, the United Nations Development Program, the World Bank, and the International Monetary Fund, and was a visiting scholar at the CFPB. Professor Jackson is the lead faculty advisor to HLSBFI and teaches a course on fintech at HLS. Finally, before we move on to the event, I must inform you this event is being recorded and may be broadcast. If you choose to participate in the discussion, you are presumed to consent to the use of your comments and your image in these recordings. That's the legal bit. That's why this is blockchain, fintech, and the law. If you don't wish to be recorded, please contact the event organizers. So without further delay, let me hand it over to Professor Jackson while thanking all the speakers for being us here today. Professor Jackson.
Thank you very much. It's a pleasure to be here, and congratulations to Eloi and the other organizers for putting together a great panel and a great couple of days of fintech discussions. Basically, I'm going to turn it over to the panelists in a second, and I'm going to ask them some substantive issues about their work, and also just to begin to say a little bit of biographical detail. Eloi told you where they are today, but I think it's sometimes interesting to know how panelists got from law school. They're all lawyers, but how they got to fintech. I will say that there are 3 JD MBAs on the panel, including me. Ben is also a joint degree person. I think he outranks us, but he has a PhD in chemistry. So one way to get started is lots of degrees. So Ben, why don't I begin with you? And in addition to the biographical stuff, and financial, Eloi mentioned amazing presence in the payment system, and also an emphasis on financial inclusion as part of that payment system. So if you could speak to what Ant Financial has done and the inclusion piece, I think that would be a great way to get started. So,
sure.
Ben?
Can I have the look?
Yeah.
Hi, everyone. I'm really happy to be here. I'm the unlikely candidate to talk about fintech because I studied chemistry, and in my early years, I did work for chemical companies and pharmaceutical companies in law firms in the US. Then for personal reasons, I moved to China. But I thought I was just going to be a law firm practitioner and retire. But then Ant Financial came talking to me about this opportunity. I decided to look at what they do. That really surprised me. The company is about financial inclusion, a concept put out by the United Nations. It means everyone in this world must have equal access to financial services. It's probably hard to imagine sitting here in Boston, there are about little over 1 billion people in this world who don't have a bank account, okay? If you don't have a bank account, how do you have access to capital, okay? So Ant Financial is about using technology to reach the bottom 80%. You've all heard about the 20/80 rules, right? So the top 20% of the population in the world is very well served by the existing banks and financial institutions. And the bottom 80%, some of them just don't have access. If you don't have access to capital, you don't have a chance in life, really. So a lot of poverty is a result of lack of opportunities. So we're using technology to reach them. And you can't afford to open branches in rural areas. So what we do is use biometric authentication to identify people, to allow them to open bank account. In Alipay app, you can borrow money. If you spend money on our platforms, then we have data of your transactions, and we can price credit based on the data. So once you have the data, you can price risk, and you can start to lend people money. And if you need, say, $1,000, you can't go to bank and get a loan like that, or $500. For most banks, they process loans by human, okay? So the cost of loans is relatively high. So if you borrow, say, $1,000, it's just not worth banks' efforts to do it. So, but many people in this world, they have a lot of needs for little loans. So on our platforms, we can price the risk based on big data and AI algorithms. So we can loan money on our platform automatically without human interaction. So each loan costs about basically 25 cents. So that's how you reach the bottom 80% of the population using technology to lower the cost, to bring down barriers. For example, in China, mobile payments have caught on, and according to some statistics, this year it's going to exceed probably $30 trillion. $30 trillion mobile payments in China, okay? It's greater than China's GDP. How did they do it? Because you can basically use a barcode to scan for payments. Let me demonstrate it here. This is a QR code. You scan this, your money gets transferred. In 2014, there's this American author who wrote a paper saying barcode scanning would never be the mainstream of mobile payments because it's not secure. But our technology made it secure. It's cheap, easy to implement. Mom and pop can easily do it. Whereas NFC technologies, like Apple Pay uses NFC technologies. It's called near-field contactless communications. Okay, it's great, it's safe. However, the startup cost is really high. So the equipment cost is really high. So mom and pop shops can't afford it. So you could not really roll all over the world. So to reach 1 billion, you have to have technology that's cheap and easy to implement. So that's what we're about. To use technology to reach at least 1 billion people. We hope to reach 2 billion people. Currently, we serve about 1 billion people around the world, with 800 million people in China, and then 200 million outside China. But our goal is to get to 2 billion, meeting their basic needs. That's what we're all about. This is why I gave up my cushy job in law firms and went in-house. To tell you what, in-house practice is wonderful. I never thought about that. So let me just stop here. I think I blabbed on enough.
That's great. So let's turn it over to Daniel next. Daniel actually works in the mobile space too, but in the U.S. space. And I know it's a little hard to come after that 1 billion figure, but if you could talk about where things are here, and maybe a little bit about the regulatory structure. Ben didn't mention it, but Ant Financial, as I understand it, grew up without a lot of regulations around it, and they're kind of being filled in now once the footprint's in place. In the U.S., we have an elaborate regulatory structure, thankfully. It gives me something to teach. But it creates some challenges for new entrants. So, Dan, if you could just, don't forget your biographical, how you got to where you are, piece too.
Thank you, Professor. And thanks, everybody, for coming. I'm really excited that there's this much interest in this space. And Benjamin is a modest man, but Ant Financial is an amazing company and has a footprint on the mobile space like really no other industry in the world. So mobile has taken off in China, in large part thanks to Ant. Hasn't done so here, though, for a number of factors. So if you, and also I just want to comment, so Joel and I and Benjamin, we see all sorts of businesses. So if you guys have any questions in FinTech at all, you can interrupt us and ask your questions, even if it's not pertaining to what we're talking about. One thing about FinTech is I made the transition from being a bank lawyer to a FinTech lawyer. And in FinTech, you have a life of variety. When that telephone rings, you don't know who it is, whether it's a 18-year-old kid who has $500 million that he got in crypto and is now starting his own currency, to a seasoned executive who wants to make a challenge in the payment space. It's really exciting, and I learn something every day. And one of the best parts about the job is that I come in contact with some of the smartest people in the world. And actually, blockchain attracts some of the brightest minds, young minds that there are out there. Most these days are tending to eschew college altogether. So that's the thing these days. If you get to your degree in college, you're wasting time. So you instead get into Fenwick and start up your company.
Are you telling everybody to leave right now?
I wouldn't necessarily recommend that, and your parents wouldn't be happy with me to say that, but that's certainly what we've been seeing, and it's thanks to Zuckerberg and others who have shown that they can do it without full degrees. So our firm, Fenwick, we only do technology, so we're different than most firms. We were the first technology law firm. Our founder, Bill Fenwick, is an amazing man, and he left a safe life of working on Wall Street and started the first firm in Silicon Valley. At that time, he had decided that he wanted to do technology because he identified technology as the most important factor that would impact our economy. And he was looking at firms to start, and he actually chose between Albuquerque and the Valley, and he ended up in the Valley, which was a great choice because about 3 months later, thanks to his wife who was at one of these beer brewing groups. So it was a group of people who were doing homebrew, and Wozniak and Jobs were there doing their homebrew, and they asked this question, is there any lawyer who knows anything about technology? And of course, there weren't any. But there was Bill Fenwick, so that guy who started our firm, and Jobs came in with the Apple I, which if you know about the inputs on the first Apple, it was actually a typewriter that he placed the inputs at the end, and the person who started our firm actually did a program on that, and that's how we represented Apple, and we incorporated Apple a few months later, and it's been an amazing run. We focus on the companies that are most disruptive in the space. So we represent Airbnb, we represent Uber, we took Facebook public, we have a whole litany of all big, huge companies which you've heard of, but that's not our core business. Our core business is taking in startup companies and growing them. And every year we take in a few hundred startups. We have a selection process to do that. And these typically are very young people who have no funds. And we have a selection process. We take about 1 of every 4 or 1 of every 5 startups that come to us. And in the fintech space, we probably take in about 1 a week now. It seems that we've been pretty busy, and it's tougher to filter the ideas. Anyway, that's about Fenwick. So I've managed to find myself, and I also sort of left a situation where I was representing banks, and my partners could not understand why I would ever leave the banks. Banks were sort of the safest clients for firms. They were steady payers, and I was interested in technology. And I made that switch, and I did it because I had a passion for it, and I thought at that time it was a foolish economic decision. But I think that that's really the answer in law and anything, is to follow your passion and what you enjoy, and that's your best. That's the best way to a satisfying career. And I couldn't be at a better firm. So anyway, I'm here to talk about mobile payments, and we, as a whole, the payment industry is way behind where we need to be. So about 10 years ago was when the white paper was released on Bitcoin. And there we first saw a vision of free peer-to-peer payments, that you could make payments peer-to-peer without an intermediary. And the reason for that, as Satoshi points out in the white paper, is that if you look at history, every intermediary fails. So whoever it is, whether it's a money transmitter or a bank that's in the middle of your payments, it's only a matter of time before the forces of greed result in theft, or mismanagement results in the failure of intermediaries. So that's the dream of Bitcoin, and it hasn't been achieved yet for a number of reasons. But that was the theory, is that you could make a peer-to-peer payment for free to anyone in the world in any denomination. We are not there. So I assume you guys all use Amazon, so that's one of our clients, and it's an amazing consumer service. When I buy something on Amazon, the payment card companies actually make more money on that purchase than Amazon. So Amazon has very skinny margins on most purchases. They make less than 1%. The actual value is going to the credit cards. So I know that it seems to be super efficient and easy, and it is good for the consumer, but it isn't efficient at all. Payments have not caught up to the internet yet. And this is something that we're going to see over time, and there's been a concentration of young companies that are looking at this problem. But it's going to be a slow transformation, and it's going to be extraordinarily disruptive. If you look at the purpose of credit cards, initially there were huge data centers that verified that the owner of a card was who they were, and people would dial it. You don't remember this stuff, but they'd actually take an imprint of the card, and then they'd have to call the call center to verify that the card was good. And somehow that justified the 2% in charges that the cards would take. We're going to see the credit card industry be entirely disrupted over the next 10 years. because they're companies like Ant who are finding ways to process payments cheaply and more efficiently. In the mobile space, the one thing that's difficult in our country, and this goes back to the banking laws, and I'm sure Professor has taught on this, but there is really no one regulator of this type of service, which creates a lot of friction and expense in forming a company. In the space of what we call money transmitters, that is a person who receives a payment to make that payment to a third party, if I can sort of do it in a short form. That is a very weird business as far as the regulatory structure. So let me give you an example. So Amazon, as I said, was a client. For many years, so when Bezos started the company, he was just a bookseller. So he bought books and sold it. So that's just a merchant activity. That's not a financially regulated activity. You don't need a financial license to do that activity. So he just, for many years, anything that you bought on Amazon was sold by Amazon. That changed about 5 years ago when Amazon became a marketplace. So then you guys probably notice when you buy stuff on Amazon, it's not necessarily Amazon that's the merchant. It's some weird merchant you've never heard of. So in that case, you're paying Amazon, and then Amazon in turn pays the merchant. That's called money transmission. The same is true with Uber. So Uber, we represent Uber. You get into an Uber. You pay Uber for the ride. However, Uber then pays the independent contractor that's a driver. So basically, they're a middle person for payments. And that activity is a regulated activity. Banks are, by charter, allowed to do that, but most of these companies aren't banks, and the banking charter is the most difficult to get. Instead, most of these companies operate under a money transmission license. And the interesting thing of that license is it's a state-by-state license. So you actually need to go out and get a license from each state. There's also a federal registration, which is quicker and easier. But that framework, where it's a state-by-state licensure framework, makes it difficult to penetrate this industry. So I think I've probably gone too long, and you can see from hearing from me, I can talk forever on this, because this is my favorite topic. But overall, the issue of mobile wallets and mobile payments, we've just started here in the US. We're way behind in the US than other countries. This is going to be an area where we're going to see a huge amount of wealth into these new companies that disrupt the current players, and I look forward to helping clients do that.
Thank you very much, Mayor. So let me turn now to Joel, speaking a little bit about another piece of the fintech sector, which is asset management, as well as some background. And we will have time later on, I hope, for questions to follow up on the topics, but we're just going to lay out a little bit more of the waterfront here. So, Joel?
Sure, thank you. So let me very quickly tell you about my convoluted career and how I got to this space. I was a fairly traditional associate at Sherman & Sterling doing M&A and bank finance. And while there, I was lucky enough to spend a couple of years in their Paris office. And as a result of that, I was recruited by a French bank to start their U.S. legal department. So I left Sherman and spent a number of years in-house as a general counsel for a French investment bank. While I was at the bank, because I had so much free time, I got an MBA and then left them to become a venture capitalist for a few years. After that stint, when the dot-com bubble burst and it was time to get a real adult job again, I came back to law firm life, and I was primarily doing structured finance at Jones Day. And in 2014, a litigator at Jones Day got a call from Overstock, and it was a consultant working with Overstock, and he said, hey, Overstock wants to issue a security on the blockchain. They're using a West Coast firm. They're not your firm, don't worry. They're using a West Coast firm, and they're not happy with them, so can you guys do that? And the litigator said, dude, I don't even know what you're talking about. So he called me, and again, this was 2014, he said, Joel, can we do this? And I said, let me get back to you tomorrow. And so I went home that night and I Googled what is blockchain. No, wait a minute, this is being recorded. No, I was already an expert in blockchain, but I came back the next day and I said, well, you know what, we can talk to them. And so the Overstock team flew in from Salt Lake City, and lo and behold, they hired us. And I spent most of my time over the next few years trying to figure out how to issue a security by a public company on the blockchain. And in order to get the SEC and FINRA sign off, literally what we did is we took every step of the code, computer code, and what it takes to start to get its security from its issuance point to being issued and traded. We had all of these charts with, with arrows and circles and squares and all of the things that coders do. And then we mapped that out to all of the security laws under the 33 and 34 Act. And literally, we took every step from a coding standpoint and looked at how that matched to the regulatory side to see where the gaps were, to see where the holes were. And then from that standpoint, we started to talk to the SEC, and a lot of it was mutual education as to what it would take to actually be able to issue and trade security on the blockchain. And what was fascinating was dealing with the areas where there was a mismatch between the technology and regulations, which is really what fintech is all about today. So as an example, one of the debates we had with the SEC was surrounding clearing, because when you're issuing and trading a security on a blockchain, literally, it's simultaneous or near simultaneous trading and settlement of a security. It's, in effect, parties come together, boom, it's done. You don't need an intermediary. But the SEC kept saying to us, well, wait a minute, who's clearing the trade? And we said, there is no clearing. And they said, there has to be clearing. Security laws contemplate clearing. Security markets can't function without clearing. We said, there is no clearing. And so ultimately, in order to get past that stalemate, Overstock bought a small broker-dealer called Pro Securities, which was eventually renamed T0, and they bought that broker-dealer because that broker-dealer had an ATS platform. And so as part of getting the approval to trade securities on the blockchain, we also amended the Form ATS, which sets out the authority as to what an ATS can and can't do, to get permission for the ATS to trade digital securities. And the whole reason we did that is because an ATS under security laws can self-clear. And so we ultimately said to the SEC in the filing, so if you go to the registration statement for Overstock for its class of digital securities, it's fascinating because we actually say in the filings that there is no clearing, but the SEC doesn't agree with us. And so to the extent that there is clearing, an ATS is entitled to self-clear, so the ATS is doing the clearing. So it's amazing that we actually got this approved, given that that debate really exists in the statements that were filed and approved by the SEC. And so we had to take things that we could do from a technological standpoint and back away a little bit. So for example, we said that they said, who's going to keep the ledger for the stock? And we said, it's on the blockchain. And they said, yeah, but who's responsible? We said, it's on the blockchain. If you want to see it, SEC, open up your laptop. And they said, no. If there's a problem, whose door are we going to knock on? And so ultimately, we said, all right, tell you what, the ATS will keep a parallel private ledger of the transactions on the blockchain. Now, in reality, it was in effect taking a photograph of the public blockchain and mirroring it, but that at least gave comfort to the SEC so that if there was something wrong, they had a door that they could knock on. And so after 2 years, all of a sudden they said, hey, this stuff is pretty cool. It's really challenging. It's fascinating. You're not going to get bored doing this. And so I came to my current firm to start their FinTech and Blockchain practice. But how this kind of all ties into what you're talking about is that whenever you have technology that's moving at a fast pace, it causes a lot of disruption. And blockchain technology and other related things that people are doing in the fintech space, are quite disruptive. And when you have that much disruption, industry always has to try to catch up, and regulators have to try to catch up. But what makes financial services different is that unlike a lot of other industries that have had to deal with technological revolutions, financial services are much more heavily regulated. And so the clash between technological disruption is much more magnified in the financial services sector because of that. And it's compounded further by what we already heard from these two gentlemen, which is that one of the key elements of what we're seeing today is disruption or disintermediation. Players that historically played a role in financial services markets are not necessarily going to be there in the future. They may not be necessary, and technology is pushing them aside, like the clearing example. And so if you're getting rid of intermediaries, like a clearinghouse, or like a share registrar, or like a bank, that are traditionally the touch points as to how regulators regulate, And you're replacing that with technology where people can access on their cell phones payment systems that's being provided by a technology vendor that may not be a bank. How do you regulate that? Can you regulate that? Should you regulate that? Is the solution taking these types of players and forcing them to become banks? Or is it coming up with a new way to regulate them and completely rethinking regulation? These are fascinating challenges. It's going to take many years for this to sort out. In the meantime, the technology is not going to sit back and wait for it. It's going, a million miles an hour no matter what. And so we're seeing right now in real time on a daily basis, regulators being forced to rethink how they regulate, trying their best to catch up. And in the meantime, we're seeing that gap between where the technology is and where regulations are, at least for the moment, getting, I think, bigger and bigger all the time.
So one of the things that everyone has talked about here has been innovation and disruption and new intellectual human capital being created. But I want to ask you all about the protection of this. So new ideas are coming along and disruptive, and there's a open source culture in some places and not in others. But IP, are we looking to patents to protect? Are we looking for contracts of the sort that Eloi gave, that you all agree as soon as you listen that this is going to be the rules? Or is this a challenge to kind of maintain, competitive advantage when you have an innovation? So, just thoughts on that.
And you want to?
I'll make comment on that. Thank you. If you look at patenting blockchain, the United States started early. Then now China is taking over. So if you look at number of patent filings on blockchain, China has surpassed the United States, and we, of course, takes the honor of being having the most patent applications filed among all companies. Blockchain or AI presents some unique challenges. To me, what's really important is the algorithms that drives AI or blockchain. For blockchain to work, it got rid of the clearinghouse. Instead, it puts in a cumbersome consensus mechanism because there's no center which says, yes, I approve. So to get rid of the center, you have to create a consensus mechanism. It's done by algorithms, okay? But the law in most countries, even here in United States, says algorithms just like mathematical formula, which shouldn't be patented. Now the US Patent and Trademark Office director says, let's make AI algorithms patentable. So he's pushing from sort of the regulator's perspective. But for those who are patent junkies, there's this Supreme Court case called Alice, which pretty much killed opportunities for algorithms to be patentable. But in other parts of the world, we're still hoping that someday algorithm is going to be patentable. Of course, in the US, there are people who are pushing. So I'm just raising a question in terms of protecting intellectual property. You should all think about asking yourself the question, why algorithms are not patentable? I'm not saying it should be, but why not? That's a question we should all debate.
There's just one aspect of this question, particularly with respect to blockchain, which is that at least early on, there was a utopian element to blockchain technology innovation where the mantra was open source. And so I think we went perhaps too far down the road of making everything open source because the idea was to create platforms that then people could build whatever they wanted to build on top of it. And we had people forgetting the notion of the value of intellectual property and patents. And so where we need to come out, I think, is a balance between the notion of having certain things open source to encourage development and innovation, but recognizing that a lot of this technology in the fintech space and the blockchain space is being built on whether it's algorithms or other concepts that are good old-fashioned unique technologies that need to be protected. And so I'm hoping that we're going to actually see things coming back a little bit towards that space because I think we went too far down the road the other way.
Yeah, no, those are very good points, and Ant has really led the way on these patent filings. Certainly when you start your own company, or those who do, having a IP plan is important. And that's something that you always look at with a startup company is anything that they're doing potentially patentable? But as Benjamin points out, this is a tough area generally to find unique patents. One is the issue that, as Benjamin pointed, that algorithms and mathematical formulas themselves, of course, are not patentable. Another is that there's always been a reluctance in the U.S. to give patents in the financial space. The thought is that that should be a space that's more open. So it's definitely an area that's more of a challenge. And it is true, very true, that this all runs against really what the true blockchain believers think. And if you read what they say about patents, is they feel like nothing should be patented. So it's always interesting to hear that point of view with these new blockchain companies. And we talk about, hey, that's a great idea. We should look to see if you can patent that. And their answer is I would never get a patent. You know, I'd use a bank account before I got a patent. So, anyway, yeah. So it's a very interesting area.
But you know, you're seeing a lot of startups come into you, and you know you're doing the legal work. But how often is it that the startup? It may be a good idea, but it's going to be hard to be sustainable without Google or Amazon or some of the tech giants just eating you up. So is it sort of all you're going to do is have a couple good months and then you're going to die?
It is true that this has been an area of tremendous acquisition lately, and some of the largest fintech deals ever have recently been announced. There are actually many of those companies that you mentioned are really great in encouraging entrepreneurship within that company. So Google is an example, and we do work with Google Ventures. That's their sort of internal incubator. And if you're at Google and you have a good enough idea, they'll fund it and let you start your company within Google. And then they do what we call a spin-off to spin it out. And then oftentimes it does end up being reacquired by Google, interestingly. Those big companies have actually seen the value of having separate teams build companies. And it is true that many companies are acquired quickly, but that is never a good plan. And that's always a warning sign when you hear teams talking about acquisition. So generally, when we look at teams and evaluating teams, the most important thing is the quality of the management. So that's the smarts that you young people in this room have, that no one else has. And that's more important than anything else. When we select whether or not to take a company on what we call our deferral program, so those are the companies that can't afford to pay, we make a judgment. We have a separate committee that makes a judgment as to whether or not a venture capitalist might finance them in the next year. And if we believe that there's more than a 50% chance that a VC would finance them within a year, we do bet on them. So that's sort of the criteria. But it's critical that, you know, from that early point, the goal is a sustainable business. If it turns out they're acquired along the way, great. But that's, to me, that's always a bad sign when people sort of form a business with the idea that they're going to be purchased, within such a short period.
So let me ask another informational question, which is about personal financial information. And Benjamin alluded to the Ant Financial credit underwriting model, which is, I think, it's a big part of fintech is manipulating data for pricing of insurance products or credit products or other products. And finance is about uncertainty, and information can reduce uncertainty. But there's developments in Europe, maybe at some point in the United States, that may change the allocation of rights, increase consumers' control over their own information. And how do you see that? Is that a threat to fintech, or how do you think about maybe the changing orientation about personal financial information and other information?
Okay, let me take a crack at this first. It's both an opportunity and also a burden. GDPR is a huge drain on a lot of companies, including ours. So it's unfortunate that legislation has gone so far. It need not be that far, but it did go that far, so it's unfortunate. Of course, we don't have time to kind of just expand on that. I'm happy to talk to anyone afterwards. Second is, once the regulations, the law are enacted, innovators will find a way to comply or actually get better. So there are technologies being actively researched. One is called multi-party computation. The other is zero-knowledge proof. These are all cutting-edge research areas where you can share data without sharing the sensitive data. For example, there are many companies, they have their own data. They are all too scared to share. So because it's their data, okay, plus the law doesn't want you to share. So multi-party computation allows these companies to allow computation to occur, so to credit model to be calculated without reaching underlying sensitive data. So this area is being actively researched. Another is zero-knowledge proof, which allows you to, for example, on blockchain, maybe you don't really need to know I wired Mary $30. All you needed to know is I wired Mary some money. That's enough. So that kind of proof is also being developed. So I think technologies can eventually comply or even get better at complying at the law, but the law should be accommodative, not suffocating.
Yeah, no, and I think that's true. But if you look in the big picture, we have the largest companies in the world who have made money off of personal data. And that's what we're seeing. And many people believe really the fair thing is that you own your data and that you should be the one making money off that data. It shouldn't be a payment company. It shouldn't be an internet search company. It's you. So we've seen a number of startup companies that have attempted to harness the blockchain so that, and they haven't been successful yet. One which we don't represent, there was this Brave browser, which you guys have probably read about, but the theory there was rather than Google being paid when you do searches, you would be paid for viewing the ads. We're working with a small blockchain company called Permission.io, and that's their mantra, essentially, that what you view and what you see on the internet, you'll be paid. The user, the owner of that data, is who will be paid the value of that. So this is a very disruptive idea. What this does is it takes the value of the data away from the largest companies in the world. So this is something that is not going to go easy. But this is a trend that we'll see and continue to see.
I agree with that, and I think that's why ultimately this is an area where it's going to be the marketplace as opposed to regulators that push it forward, because it's a combination of the technologies which are just in their infancy that are allowing people to start to control who gets access to their data and how they can dish it out to different players. But it's also convincing and educating generations that they are valuable and that their information about themselves is valuable. And so there's once we start to educate, I think, the marketplace that we all have a monetary value surrounding ourselves and what we do and what we're all about, that people would be willing at some point to pay for once the technology makes that feasible, then I think protecting consumer privacy issues really becomes a market-driven solution as opposed to regulators forcing it on everybody. And it makes concepts like GDPR, I think, ultimately, hopefully, obsolete.
Do we see in the EU with this more stringent regime products not being offered, or products being withdrawn, or the authorities of Parliament beginning to rethink the question? Is there any feedback loop working on that side yet?
I heard some companies are not doing business as a result of GDPR, but there are times you can't get around it, so you have to comply. I think there's enough complaints being made, but I don't know whether they are also looking at relaxing it. On the other hand, if you look at, I'm not advocating for the big techs, but you look at Facebook being clobbered in Germany for privacy issues. The theory is there's an antitrust violation on privacy issues. Well, gee, antitrust law should not be concerned with privacy. I mean, antitrust law is about efficiency, economic efficiency. Where did privacy come in? I'm just really surprised. But that's where the Germans are going down the path, and same thing as the European Commissions. I mean, I'm just really surprised.
Okay, well, let's see if I can get some more surprises. We have a few minutes for Q&A, and I think the microphone has got to follow. So, Eloi, do you want to be carrying this, or do we have any hands? Or okay, start.
Sure. Shall we wait for the microphone?
Yes. Sure.
Hi, thanks for coming. I want to ask about the kind of accommodative regulatory structure and that sort of like idea compared with the general idea that people have about innovation thriving in deregulatory environments. And at least like in the US, both now and in the past, you might have something like the Electronic Funds Transfer Act, which was a law trying to encourage people to adopt currency through like a regulatory regime. Kind of already mentioned like blockchain advocates, now trying to get the government in, whether through legislative initiatives or otherwise. I think like forest data portability came up. So, I mean, what's your kinds of thoughts on that? Is there like a role for regulations to not just stifle and like actually encourage tech and innovation?
Has anyone encountered regulation of that sort?
Right, like the UK has forced same-day payments, and we don't have them here yet, for example.
Yeah.
Well, the U.S. regulators are trying to experiment a little bit with the equivalent of some of the sandboxes we've seen in other countries, but I don't think they're as far along. And I think the challenge in the U.S. is that for the most part, we have a rules-based regulatory regime as opposed to principles-based. And I think that if you look at some of the jurisdictions that use principle-based approaches, it's easier for them to interact with the private sector and develop new approaches together. And so I think that's a fundamental structural problem we have in the U.S. It doesn't mean that regulators aren't trying to understand, and they're not trying, they are trying. The SEC, for example, is trying to move forward on the blockchain space, but I think it's harder in this country for many reasons, and that's part of it.
No, that's true. And one thing about the financial laws is the penalty for violation is much higher than in other areas. So Uber is a good example. When they came to us, they had a business model for a ride-hailing service. And if you go to a lawyer like me, the answer is okay, let's start to get our taxi cab licenses. We've got to go jurisdiction by jurisdiction. That's an area that violation of that law, the consequences aren't as extreme as violation of financial services law. So that's sort of an area where the company just went for it and disrupted it, and the consumers loved it, and then there was no stopping it. And any fines they had to pay were minuscule compared to the value of the service they were offering. That doesn't work as well in fintech just because the consequences are much more severe. So I do think that it's just sort of the nature of the beast here, and that's what makes our job so challenging as fintech's lawyers, is that we have a very difficult set of laws to maneuver here. And that's really the challenge of and the art of the business.
Yeah. In back, the shout out.
Yeah.
Here he goes.
I'm sorry, I want to correct you. The zero knowledge proofs is not developing technology. It's being used in Zcash, Monero, Zencash, and so forth. The question that I have is, and I hope it's not a dreadful question that you were talking about. I did not know that the reason Patrick bought the company is to be able to do what he is doing. I want to come back to smart contracts. What do we have to, now I'm curious who came up with that scheme, because I would like to know what would it take, what kind of a company somebody would have to buy in order to be able to use smart contracts as a regular contracts in a contract law.
So what was your question? Who came up with the smart contract?
No, my question is, since Patrick had to buy a specific company in order to photograph the screens of the blockchain to be intermediary, I'm curious, what would it take for the smart contracts to be accepted in a court of law as a real contract? And what kind of company would somebody have to buy in order to be able to do that?
Okay. I'll take a crack at this. Smart contract executed on the blockchain assumes there's a valid contract, then you're just writing the terms of the contract on the blockchain. So it doesn't, you're raising the question of contract formation, validity, and enforcement, all that. But really, it's a rule-based execution of contract. Say, if, say, my son did 3 errands for me, then I pay him $100. So if he proves he did those 3 errands for me, then I'll pay him, or my account pays him $300. So it's all just executed on blockchain, but it doesn't really speak to the validity of the contract. That's my understanding. But there are people who do question these kind of, validity issues, but I think that's going to be the court to decide.
So the one requirement the dean has for moderators of the luncheon talks is that they end at 1 o'clock. So those of you with classes have a fair chance of getting to them. I think the speakers are willing to stay around for those who don't have a class to do some follow-up questions, but at this point I'd like to thank the panelists for a very interesting session.